Begin. A very warm welcome to all participants and thank you for joining today's webinar. We have over 250 registrations and many participants are joining as we speak. Uh, Today's webinar is particularly of interest and important because of the kind of scale of financing that is required for renewable energy related investments in the sector. We all know that due to variety of environmental, social, and techno-economic reasons, it is very clear that the Indian power sector needs to significantly ramp up capacity addition from renewable energy sources. It is expected that in order to achieve the national ambition of 500 gigawatt of non-fossil fuel capacity by 2030, we will need debt financing of about 14 lakh crore rupees in just 8 years of this decade. As we embark on this massive debt funding for the RE sector, we need to be cautious and ensure that we do not repeat past mistakes. In this context, we recently published two reports looking at RE finance. One report looks at the risk nuances of RE financing, and the second report looks at the implications of the recently introduced expected loss rating scale specifically for the infrastructure sector. Both these reports are available on our website and we'll soon share links to these reports in the chat box. My colleague and author of these reports, Sonali Gokhale, will today present main contents, messages and recommendations from these reports in about 30 minutes of presentation. After this, we will have a question and answer session. We plan to end today's session in about an hour's time so that you can plan accordingly. Before we begin, quickly about Sonali Gokhale, who is the author and presenter for today's webinar. Sonali works on issues pertaining to RE and conventional energy finance. Prior to joining Prayas, she has 13 years of work experience in credit risk management in corporate banking with a focus on infrastructure and project finance. So not just academic or research experience, she has practical experience of the entire finance sector and specifically lending to infrastructure sector and issues involved in that. Before we begin with the presentation, a few housekeeping announcements for smooth conduct of this webinar. I request everyone to ask their questions by typing them out in Q&A window. Chat function is disabled for all participants just so that we can concentrate and have one channel of communication for answering your questions. All participants will be on mute throughout the webinar. Clarification questions on the presentations will be answered through the Q&A window, and wherever possible, you can refer to specific slides if in case of these clarificatory questions. Q&A window is located at the bottom panel of your screen. We will discuss questions of broader nature during the Q&A session after the presentation. We will collect questions of similar nature and take them up together so that we don't repeat questions and try to address as many participants' questions and comments as possible. In case we are not able to cover all questions in today's session, then please email us and we'll be more than happy to come back to you and respond to your questions. Lastly, we are recording the webinar and it will be made available on Prayas website in a couple of days. So once again, I welcome you all to this webinar and request Sonali to start her presentation. Over to you, Sonali.
Thank you, Shantanu, for setting the tone and giving everyone a context of what is it that we are going to discover today together in this webinar. I'll start off with welcoming everybody and thanking all the participants for taking time out of what I'm sure are very busy schedules to come and listen to our conversation on this issue, which we believe is very, very timely and very, very critical to public discourse around renewable energy finance in India, especially in the context of the stiff targets that we've set for ourselves. I will begin the webinar, the presentation by taking you all through the outline of the presentation. The outline of the presentation the flow would flow as, first of all, we would like to explore what is India's RE finance appetite. Shantanu mentioned in his introduction that it's about, the debt itself is about 14 lakh odd crores. So we'll try and see where that comes from and what is the total capital outlay that is required. What is the current position, or what has been the kind of investment or enthusiastic response to our requirements from various sources of financing, domestic, overseas, FDI, etc. To follow that, we will also have a meditation on what is India's finance risk perception as of today. Since RE has now been around in India as a sector for a good number of years, and the regulatory changes have also been few and far between in the initial stages and more frequent in the recent few years. So to try and see whether from the credit risk measurement perspective, what is the kind of inputs that go into making up a view about a particular RE project being credit worthy, riskier, not riskier, etc. Followed by this, we will take a look at what is the current credit risk measurement methodology or landscape for renewable energy finance, and then segue into how it has been changing from the regulatory guidelines point of view, as also from how it has shaped investment decision making. We would like to then delve a little bit deeper into the newest innovation in credit risk measurement for overall infrastructure sector, with a focus on renewable energy finance, which is the expected loss rating scale and its implications. And we would like to end this presentation by discussing some of the recommendations that we have been able to formulate after our internal discussions and our sort of formulating our views on the entire changing landscape of credit risk measurement. So without further ado, let me start off with India's RE finance appetite. We know that we have set ourselves a very stiff target of 500 gigawatts by 2030. As of today, we are already at 152.3 or slightly more than that gigawatt of RE capacity installed basis. If we are to look at our additional utility scale RE target of 340 gigawatts, we would essentially be looking at an outlay of 17 lakh crore rupees. This is the full capital outlay, including equity and debt together. It would be about USD 220 billion, give or take. The way that we have come out with this number is that we have assumed capex cost per megawatt for solar at rupees 4 crore and for wind at rupees 7 crore. We have assumed that the incremental target will be a mix of 60-40 of solar wind. At an 80% debt equity ratio, which is typically what will happen for a well-stabilized operating project of utility scale, the debt requirement for this additional target would be about 14 lakh odd crore rupees, which translates to about 180 billion USD over a period of, when I started this presentation, I'm making it was 9 years, and now we are into 8 years left, 8.5. So as of today, there is no real consolidated database where we can just at a snapshot come to a conclusion as to how much money, especially in the sense of debt, has been put into Indian RE. So banks and FIs are still something, Indian banks and FIs are still something that we are able to track from some regulatory submissions that they have to make to the Reserve Bank of India, which as of today, as per publicly available database, it's about 1.22 lakh crore rupees, which is about 16 billion USD. The ECB, FCCB and rupee denominated bond route has been typically seeing inflows of about $2 to $2.5 billion, pre-pandemic era. In the year ended 31st March 2022, we have seen a record 5.43 billion USD versus 2.75 billion USD in the earlier similar period. And we have information for FY20 only for FDI, which is about 1.39 billion USD. Now, when you look at all of these numbers on the right-hand side and compare them with what is required as to reach the goals on the left-hand side of the slide, we can see there's a huge gap that we need to make up. To put the required number in perspective, the loan book of the largest bank in India, which is State Bank of India, which is a public sector bank, as of 31st of March 2022 was about 29 lakh crore rupees. And that of HDFC Bank, which is our largest private sector bank, it was about 14 lakh crore rupees. So that is their entire loan book to all the sectors, to retail, to MSME, everything put together. So we can see that, hitherto unseen amounts of debt will need to flow into the sector to achieve our goals. From this, we would like to bring your attention to what has been the experience of lending to RE already, now that we have been in the RE sector and we already have about 150 gigawatt plus of capacity that is installed. So in 2022 January, there was a report that was brought out by the Standing Committee on Energy to the Lok Sabha, which covered the RE lending experience of the three primary government-owned NBFC participants, which was PFC, REC, and IREDA. So apart from the many other things that were discussed in the report, a very interesting snapshot was provided of what are the non-performing asset numbers for these three financing entities. Non-performing assets are basically loan assets which have remained overdue as far as interest service or debt repayment. Either of them have been in overdue for more than 90 days. That is under the parlance of RBI. It is then known as an NPA. And any increasing trend in NPAs typically signals a deterioration in the quality of the loan asset book of a financing entity. We can see from the table on the slide that totally for these three entities put together as of 31st of March 2021, 2,800 crores worth of gross NPAs have already presented themselves. If you look at it from the slice of by lender, IREDA is reporting a gross NPA ratio of 8.77%. Which is, if you compare it, let's say, with the GNPA ratio of the State Bank of India, which is the largest public sector bank, a mishmash of all types of risks, it would be about 4.98%. So this is nearly double, if not exactly. Even after the provisions have been made by IREDA, the net NPA ratio still comes to 5.61%. These are definitely on the higher side and indicate high stress of asset quality for IREDA already for their RE book. The granular data that is provided by IREDA also yielded certain insights into what are the reasons for the NPAs that have crystallized on their books. 30% of the NPAs are attributed to delays from discoms, the delayed payments, which is, I think, no surprise to anybody. And another 20% would be about execution delays or challenges in actually making the projects operational. And 15% were attributed to generation-related issues and other technical parameter issues. Similar granular data is not available for PFC and REC, nor in their annual reports, nor in the Standing Committee report. The large difference in the RE-NPA ratios between IREDA, PFC, and REC needs to be better understood. Because if IREDA has got a much higher number that they are reporting versus PFC and REC having fairly large books and reporting such low numbers, I think it's a matter of concern and scrutiny and investigation. So if there is better data, which we hope to achieve through our recommendations, if we are able to have better data of RE-NPAs reporting, we'll be able to come out with certain understanding of the same. So what has been the current credit risk measurement for renewable energy? Overall for corporate credit risk assessment and specifically for RE is the Securities and Exchange Board of India governs credit rating agencies which assign credit ratings to loan instruments based on probability of defaulting on single rupee shortfall, single day delay paradigm. This is a scale that starts from AAA to D, and it measures the probability of default. I will skip ahead to the next slide so that everybody can see what this scale looks like. So it starts from AAA, which is obviously the highest degree of safety for timely servicing of financial obligations. Such instruments carry the lowest risk, and theoretically their probability of default should be zero because they're AAA, they're gold plated. Coming down all the way to D, where you have instruments which are already in default or they are expected to be in default very, very soon, which is almost imminent default. Those are the loans that will get into the D category. This is a descending order of strength. Between AA and C categories, there are modifiers, plus or minus, which are provided for those rating bands, which reflect the comparative standing within this category, which means that if there is a rating of A plus, it will have a better credit risk scoring than an instrument which is rated A minus, though they are in the same A bracket. These are called modifiers for comparative standing. These are certain nuances that act as very useful credit signals for institutional investors to be able to take decisions as to whether they wish to invest or not. And credit rating agency assigned credit ratings have also been used as thresholds in the prudential norms governing investment rules for public finance entity organizations or sectors such as the Indian insurance sector, the Provident Fund, the Employee Provident Fund bodies, etc. So prudential norms refer to credit ratings as investment thresholds. So one can see how critical their role is in the overall credit signaling and investment decision space. It is a licensed business. and is governed by the SEBI, as I already mentioned. The heightened the risk perception of infrastructure sector overall is reflected in certain rating agencies coming up with nearly 75% of their rated universe being in the middling category, so about triple B or lower dregs of the A band. This comes from obviously past experiences of how stranded assets have occurred in thermal and how resource lock-in has been observed there, and large NPA sitting on public sector banks and some private sector banks as well. Some other infrastructure assets like roads also tanking and not being able to service their debt. So RE also, falls prey to that because of the length of the tenor, etc. That they are able to. It's a little difficult for them to find financing because of this kind of probability of default related measurement. A recent report, I think, some study talked about a large amount of RE projects that were the debt was rated after 2015, largely are in the A band. So that is something that is indicative of where they are as far as safety perception is concerned by the CRAs. So that brings us to then what is overall the risk perception that is formed by the CRAs having their own rating views and investors taking their own calls, and then how they actually play out, etc. The majority of the current discourse around the Indian RE story is obviously speed, scale, etc. And there is this feeling that because of the modular nature of executing RE projects, they are on the opposite end of the spectrum as far as construction complexity is concerned as compared to conventional power plants. However, the most important part of the risk for RE, apart from the delayed payments from discoms, which I think is a well-established risk and everybody is aware of it, is the fact that the generation can be extremely variable and there is very little control on the generation. And aggressive bidding based on high generation assumptions makes loan those kind of projects vulnerable to the probability of default becoming higher over the life of that loan. So who are from the sector, it's common knowledge, but for those of us who are not, so the estimation of generation is basically done basis experts collecting some raw data from the field, applying some statistical analysis tools to the same, and at various levels of confidence intervals, expecting that the confidence intervals will be exceeded, will provide generation estimates. So a very popular generation estimate, which is utilized for debt sculpting or even for deciding on bidding, is something called P90, which basically means that whatever is the energy yield estimation at that particular confidence interval will be exceeded with 90% probability, which means that because of the single part tariff structure that RE has, any dip in generation will automatically lead to stress for servicing of the project level debt. Now, most RE loans are financed at base case debt coverage ratios between 1.2 to 1.15, depending on the PPA counterparty and various other risk issues, which means that if there is an annual debt service burden of 10, the numerator that is allowable or is necessary for a 1.2 DSCR is 12. If there is a 20% dip in generation, which was the case in CY 2020 for wind power, and even in CY 2021, the wind speeds were lower than expected. This would lead to a deficit of cash flows for debt servicing, where you would have 9.6 cash flows available against the annual debt service coverage of requirement of 10. This particular shortfall does not take into account any delay in receipts of dues from the off-taker. So the implications of both, one is lower than predicted generation and higher than expected delays from your off-takers or your PPA counterparties. Implications of both of these are profound, both for the debt that is sitting on that particular individual project, which is about 80% of the project cost, as well as returns for the equity investors. So it has been long argued that the risk contours for debt finance to project finance or infrastructure is considerably different from that of, let's say, corporate or industrial finance. And the reason is that because of the policy prioritization and the absolute necessity, or the must run, to put it colloquially, not technically, for RE kind of status of infrastructure, even though there might be short-term cash flow mismatches because of, let's say, demand estimation not being met or etc., the long-term economic value is largely untarnished Also, a lot of the infrastructure projects, including RE, if not all, are tendered in the PPP, that is public-private partnership route. And thereby the near policy prioritization will make the fact that their long-term economic value is left untarnished. So basis this, in the 2017 budget speech, the then finance minister had promised of a new rating scale for specifically for infrastructure sector, which would talk about, which would address this short-term cash flow mismatch and long-term economic value untarnished aspect. And in January 2017, the credit rating agencies and Ministry of Finance together developed this new rating credit framework and named it the expected loss methodology scale. Expected loss methodology was supposed to be probability of default, which we have discussed earlier, into a new concept called loss given default. It's not a new concept for where our Reserve Bank and central banks and their Basel requirements are concerned, but in the context of credit risk measurement for infrastructure, this was new. So it basically meant that even if there is a short-term default or a short-term delay in the repayment of a particular debt obligation that is sitting on an infrastructure project, the fact that if you compute what will be the recoverability ratio in case that particular project is going to be taken over by somebody else, if the debt is going to be refinanced at a lower cost, etc. So there are so many reprieves that can come, safeguards in the agreements, or there could be other market realities which would make it viable. Then this particular element of credit risk strength should be taken into account when making decisions of lending to infra. So obviously this impacts RE because RE is under infra. However, since then till now, this particular EL rating scale did not really make a dent in infrastructure or RE investments. And the reason for that is that the prudential norms where credit ratings are used as thresholds for investments, they did not recognize expected loss as a credible threshold. So April 2020, there was the task force of the Department of Economic Affairs as part of the National Infrastructure Pipeline Handbook mentioned that patient capital needs to be attracted towards this particular sector, towards RE, towards infra and towards RE both. And thereby prudential norms of these investment entities should be changed. And it will help attract long-term funds to capital. The capital market participants will get attracted towards the sector. So accordingly, in Jan 21, IRDAI, which is the insurance regulator for Indian insurance companies, it lowered the minimum credit rating threshold for infrastructure investments from AA to a minimum credit rating of A, along with an expected loss rating of EL1, which is a 3-notch downgrade. Following this, SEBI introduced a rating scale based on expected loss ratings in July 2021. In January 2017, when the CRAs had come out with their earlier scale, SEBI had not really recognized it, and there was no circular from SEBI promulgating such scale. In 21, it happened. It should be noted that there was limited public consultation before the above-mentioned regulatory changes took effect. This is what the expected loss rating scale now introduced by SEBI looks like. It starts with EL1, which is the highest expected loss rating possible to be assigned by a CRA. It's got the lowest expected loss over the life of the instrument, right down till EL7, which is considered to have the highest expected loss and thereby the lowest recoverability ratio. It is interesting and important to note that the SEBI circular, which brought out this EL rating scale, has no mention of any methodology or definitions of what goes into computing EL. Further, the circular also does not mention any numerical ranges of expected loss, which existed in the January 2017 circular or January 2017 scale that was popularized by the CRAs. So obviously there is a huge risk of inconsistent ratings on the EL scale by each CRA because now there is no common methodology. And that was one of the areas from where we started our conversation and debate as to how this should be managed and how this should be responded to. For a second, let us zoom out and look at what has been the experience of credit rating agencies and their performance of credit risk measurement. Those of us who are from the sector know very well that there is an issuer pay model in the CRA space, which means that the project that needs to be rated pays for the rating to the rating agency, and thereby there is obviously a lot of conflict of interest. There are inconsistent ratings assigned by CRAs, and this continues to be a reality. I will take a moment to just invite the attention of the participants that in one of the papers that we have published in May, which is the expected loss rating scale unexpected outcomes paper, there are two detailed case studies of the same loan being rated by two different CRAs with very different approaches to credit risk measurement and response to credit risk deterioration. So I request whoever is interested can please review that and come back with any feedback. Basis this understanding of probability of default of each rating category, SEBI also regulates CRAs to come out with something called as a cumulative default rate, which means that for each rating band over a 1, 2, and 3-year horizon, what is the cumulative default rate based on a 10-year pool of behavior of particular loan assets in that rating grade, which means that for a AAA rated loan, theoretically, the probability of default or the cumulative default rate should be 0%, which is there in the case of CRISIL. But for the rest of them, you can see that that is not true. For India ratings, it is as high as 1.88%. As we go further down the rating scale, we see that there is an exponential increase in this cumulative default rate. Also, we are able to see that there is a wide variance between the cumulative default rates in the same rating band between rating agencies. And this is a point of real concern because this is sort of a proof or an evidence of the inconsistent or the differentiated rating views taken by each CRA. So what is the implication of all of this? You must be wondering. The logic is that in Jan 21, when IRDAI permitted insurers to participate in infrastructure investments with a minimum credit rating of A, along with an expected loss rating of EL1, which was a 3-notch downgrade because of the modifiers that I mentioned before, it must be seen in the context of what it means for where this money is now going to go. LIC, which is our largest public insurer, has about 37 lakh crore rupees of investable corpus as of 31st of March 2021, which is about 470 USD billion. It's the last and most often the only source of social security for India's most vulnerable population groups. For the regulations that govern the investment methodology or the investment mix for Indian insurers, a minimum 15% of their investments has to be towards the infrastructure and housing sector. As of LIC's 2019-20 annual report, this particular outlay was nearly only 1.70%, 53,000 crores only out of the humongous corpus of 37 lakh crores for that year. This is the real implication of the change of taking it from AA only as a rating threshold to A plus EL1, because there is that huge gap that needs to be covered as per their own prudential guidelines of investment mix for insurers. And the fact that Indian RE finance has this massive insatiable appetite for finance, both put together, it's like it's a match made in heaven, hopefully, and remains in heaven and does not go towards hell. So out of all of this, meditation on all of these issues and trying to form a story around it and see the narrative and where it is leading and what is the thing that worries or encourages or puts pressure or takes pressure off, these were the 3 key observations that we ended up with. 1, a large amount of direct and indirect public monies will be involved in the RE finance pie. Hence, there's a real need for larger discourse on specific nuances of credit risk measurement for RE debt, as well as the current policy responses to the same. There are already regulatory relaxations being provided for attracting finance to the infrastructure sector. These, coupled with India's large RE finance appetite, are an area which needs to be handled with great care and regulatory forethought. And finally, supporting India's transition to RE capacity targets that we've set for ourselves calls for a change in the existing framework of RE finance based on the guiding principles of transparent and consistent disclosures, efficient and timely data warehousing, and encouraging public discourse on material changes to existing policy. So basis these takeaways, I would now like to draw your attention to the final part of this presentation, which are our recommendations. These recommendations have been detailed in depth in the reports that we have mentioned on which this webinar is based. So I request those of you who are interested, those of you who are in the regulatory space, who have any sort of say, please do look at them, and we would love to hear back from you on feedback on the same. So we'll start off with the first set of recommendations, which is encouraging a robust monitoring atmosphere and tools for the RE sector. So there are various types of places where some amount of monitoring is now happening. So for example, there is the Prapti portal where you can see a month-wise, generator dues to RE from various discoms, various states, etc. Then you have the CA website, the website where they have their annual, monthly, daily, quarterly, etc. reports, where they are talking about what has been the generation performance or the generation, actual generation month on month of various RE projects that have been installed. The problem is that with the CA reports, they cover about 20% of installed capacity today, number one. Prapti also does not cover the full universe in full detail. What we are sort of talking about, or what we are trying to explore intellectually at this stage, is a comprehensive reporting platform, which will have all details in one place. So it's a one-stop shop for your data related to the Indian RE sort of sector, which means an inventory of the projects, the amount of data that is sitting on each project, the kind of billing that is being done, the kind of invoicing that is being serviced on time, what is the number of delays, what is the generation, what was the estimate, and what is the variance between the two. We believe that this will markedly improve the transparency and information symmetry for RE, which will also then feed into more sort of informed bidding for the next the phases of the bidding that will come for utility scale RE, or even otherwise people who are putting up their own RE projects. The second part of the recommendations are about focused at the lenders and investors, which come under the AGs of the Reserve Bank of India or Securities and Exchange Board of India, as the case may be, towards emphasizing comprehensive and standardized databases. So we would like that, or it would be good for RBI and SEBI to design and stipulate a standardized reporting format for RE project level data pertaining specifically to financing agreements from all types of lenders or investors. The reason I say this is when we were trying to find out what is the amount of money that's in Indian RE and from which source, etc., from the publicly available sources, of course, what we came up with was that there were patches where the data was simply not available. So for example, the annual reports of all the financing entities under the RBI, which is banks, NBFCs, infrastructure debt funds, or infrastructure focused NBFCs as well, they didn't really delineate their RE portfolio separately. And that was a real concern, because we thought that if you're going to now scale up to the degree where we are seeing, it's very important that there is one place where everything goes in a standardized way and is available for public consumption. So drawing from that, the second recommendation is that RBI to ensure that the annual reports of all financing entities under its AGs should delineate their RE finance portfolio along with data on off-takers and annual performance, etc. Most importantly, unfortunately, it's very important that RBI to ensure that the annual reports of all its financing entities should clearly delineate their RE NPA details in a standardized reporting format, along with the analysis of reasons for NPAs and trends in NPA recovery. Now, IRDA's NPA disclosures in their annual report, which were then reproduced in the Standing Committee Lok Sabha report, were exemplary and can be used as a really good starting point where if people wish to, arrive at what sort of framework should be utilized for delineating that NPA data, it's pretty excellent. That brings us to the next part of the recommendations. These are more focused and more pointed towards the EL rating framework and the EL rating scale that the SEBI has come out with in July 2021. We suggest that the expected loss, the probability of default, the loss given default, and the formula may be made part of the RBI ratings, SEBI EL rating circular, and be commonly applicable to all CRAs. We also think that the numerical EL ranges may be standardized across the board, similar to what was done back in January 2017. Also, it would be good to have the assumptions underlying the LGD methodology public for scrutiny, ensuring transparency. And CRAs may also state their assumption actual results of the PD and LGD estimates in the rating commentary while assigning EL ratings. The LGD methodology can also be backtested with actual losses in the RE sector, especially absorbing losses in conjunction with the RBI on an annual basis. A formal platform for information sharing between SEBI CRAs and RBI may be explored, and a task force may be empowered at SEBI to make necessary changes to the EL rating approach if deviations are observed between the assumed recovery rate and the actual recovery rate. So all of this is towards making the EL tool robust, having teeth and grounded in reality, and not just a theoretical Excel sheet based sort of exercise. Because as of today, because the SEBI circular does not have a computation methodology mentioned, each CRA is now having its own way of computing EL, which are in the similar risk environment. But what is the weightage that will be given to which sort of element of risk perception or measurement, that is not clear. It is not transparent, and it is definitely not standardized. So this becomes very critical in that context. We believe that innovative debt instrument structuring may offer some optimization of measured credit risk. The recently launched RE Innovate, the debt that it raised, had some really interesting ways of safeguarding the risks that were acknowledged as part of being part of the package of that particular debt instrument. And it achieved a really, really good rating. It achieved a rating of AAA from one of the leading rating agencies. You can go and look it up if you like it. It's mentioned in our report as well. So there are various mitigants and innovative structuring that is possible. Some of them are mentioned here on the slide. It could be specific reserves, it could be higher debt service coverage ratios for differing tranches of tenors, trigger-based deleveraging actions. All of this finally to say that if you acknowledge the risk, you agree that the risk exists, and then you try and mitigate it to the best extent possible through safeguards in the financing documents or on the structuring itself, that might then not need this kind of lowering of credit rating threshold to ensure or to encourage participation in the RE story. That is the limited point. And finally, we believe that public discourse in policy making will hopefully lead to better informed and participatory decisions. So we hope that there's a space that is created specifically for engagement on material changes to investment guidelines, especially for public money entities such as governed by the IRDA, governed by the PFRDA, and obviously the pension funds, etc. And we hope that there is that kind of dialogue that is sort of set up, and it becomes an enriching platform to exchange ideas and thereby sharpen our country level, let's say, risk response and measurement response, and minimizing the credit risk distortion that might happen because of some of these gaps. With that, I will close my presentation and we will open the floor for Q&A. Thank you once again for listening. If there are any questions which are not responded to because of paucity of time or paucity of understanding probably at my end or our co-passengers, please write to me. My email ID is available on this particular screen, or you can write to our Prayas Energy ID as well. And we look forward to feedback and more participation. Over to you, Shantanu. Thank you.
Thank you, Sonali. Very clear and concise presentation. I'm sure participants should have got a gist of what these two reports talk about and what are key recommendations. We already have a few questions. So first question is more of a clarificatory nature, I guess. The question is about the ratings that you discussed. Yeah. And the question is whether these ratings are long-term ratings only or proportionate consideration has been made for short-term as well. So.
Yeah. Okay, that's a good question. So the rating agencies have got a bouquet of products that they offer, all sort of managed or controlled by the SEBI. So there is a separate rating product for short-term ratings. So if there's a working capital facility that is taken, let's say by any sector participant, whether it's industrial sector, infra, whatever, if it's working capital, the tenor is less than 1 year or maximum 2 years in the case of some sectors, there's a separate scale that is utilized for assigning near-term liquidity sort of assessment. That's called the short-term rating scale. And then there is the ratings that we mentioned, and the ones that we are concerned about in the context of RE are mostly the long-term rating scale. That AAA to D is basically a long-term rating scale. And we have focused our meditation on that.
Another question is really interesting. Is there an issue in disclosure and reporting at regulator level to make this data available, given that there are multiple regulators across finance and electricity sectors? And if so, then what are the challenges in disclosure and what can be done to address this? Because one of the key recommendations that is coming out is there needs to be much more transparency and sharing of data. So how do we address this issue of multiple regulators regulating different aspects of RE finance?
Yeah, I think that's a very very pertinent and timely question. And in fact, this is one of the questions that myself and the team we tried to kind of address this question, which is to say that since there are multiple regulators, you have got the debt side, the formal debt side of things being regulated by Reserve Bank of India. You have got capital markets being regulated by Securities and Exchange Board of India. You have got Ministry of Power and the other folks in the core electricity sector regulating the operations of those entities. It is absolutely the need of the hour for there to be a healthy sort of platform created between all of these 3, 4, 5, 6 regulators on one platform, and for to come to a conclusion or to come to that common understanding of what are the intersecting or overlapping or even discrete pieces of data that need to be there in one place, which will inform decision making at each side today. For example, today I can give you an example. The Reserve Bank of India has got its own set of reporting requirements for the overdues and delays that happen on loan instruments to it. There are various forms and blah blah. And then there is the Securities and Exchange Board of India for listed entities, for companies that are listed on stock exchanges, will have their own format for if you have delayed on a particular loan instrument, you need to inform them, etc. So the intent is similar, I think, because everybody wishes to finally arrive at the same set of ideal situations, which is that it's well monitored and it's measured and it's responsive, etc. It's just a matter of coming to the common platform. And we hope that some of these recommendations where, let's say, the task force between RBI and SEBI for, let's say, backtesting of EL, those kind of platforms and that kind of dialogue on a continuous basis is something that will finally yield this. And yes, there are lacunae today, even at the regulator side. I think it also comes from the fact that the length and breadth or the depth of the reporting requirements are so myriad. So RE might be a good example. So if you're going to get 340 gigawatts additional capacity, we already have 150 today. Each project level for, wherever the projects are located in all corners of the country, for the invoicing data, generation data to flow to that particular local level body, for then that to get addressed as to how much was actually paid, the reconciliation to happen between both parties and any disputes to be raised, and all of this data to flow to a central brain has got amazing logistical gaps today. And I think there is an element of technology also hoping to play better role going forward, and that intent that, okay, we all need to come on the same page and then it'll just make everybody's life easier, where if RBI has the same data, which then SEBI can also access, public participation can also access, and thereby there is that enhanced sharing and enhanced sort of dissemination of that data.
Two more questions. I will ask both questions so that it will be easy for you to answer. One is related to what you just mentioned in terms of data availability. So is any data available which will enable sort of different stakeholders to compare assumptions regarding RE generation when the project was actually financed and the actual performance, and maybe over a period of time, because this is essentially a long-term debt financing. So is there any source, is there any way where people can compare these two parameters? So that is first question. And second question is, what are the challenges in terms of financing RE sector? And what are the reasons why this kind of credit rating thresholds or norms need to be relaxed? So these are two questions maybe we can take, and then we'll come to the questions.
Okay. So just to respond to the first part of the question, which was about can you just repeat the first part? Some parts I missed, Shantanu, sorry.
The first part is about availability of data to compare generation assumptions at the time of financing and actual performance.
So as of today, we are actually struggling with that. Like I struggled with it when I was trying to do analysis of this sort for this paper reason, is that one place that I saw that exists today is that most of the long-term ratings or the long-term debt that is raised by RE projects, whether it be from the debt side, that is bank loans or financial institution loans, or it's through capital market participation in the forms of bonds or debentures, the entire universe is largely rated by credit rating agencies. And for them to be able to review the rating annually, which is what the practice is, SEBI mandated practice, that you have to review the long-term rating of any entity annually, they have that access to what was the, the original time when it was financed, the estimate, and then the actual generation year on year. So it is very lengthy today. It's a lot of legwork today. You have to go, credit rating agency output by output to see that. But the fact is that this is very much part of the base level questions that the rating agency would ask of the RE producer to say that if I have to rate you, if to rate your project each year, these are the 3-4 things that you have to tell me. What is the generation? What is the overdue? What was your O&M? And finally, then what is left for the equity holder? So I think that information is there. And in a very circuitous, very long drawn way, it is available today in various outputs of rating agencies where the loans are there. But there is no, formalized platform where you can just get a snapshot, and which is exactly what we are sort of proclaiming that is necessary. And to come to the second part of your question, why is it that these thresholds need to be lowered, and what is the issue? So there are a couple of responses to that. Number one is that the tenors for RE finance, RE projects to be remunerative, especially at the very, very low bidded sort of rates at which, in the competitive bidding logic, the low rates at which things are bid, especially solar. The only way that those projects can remain economically attractive and viable is if the tenor of the loan is very, very long, which means it is at least 18 to 20 years in length. Now, the banking and financial institution space, which is, constrained by RBI regulations and asset liability matching and how a bank as an entity is to be run, they are constrained in giving such long tenor loans. They cannot give 18 and 20-year loans easily because there is something called as the asset liability mismatch that will occur, that if I have a deposit that is to be due to be repaid to the depositor in, let's say, 5 years, and my loan goes for 10 years, then I don't have the money at the end of the 5th year to pay my deposit. So I can't have a mismatch as a bank. And thereby, as a bank, I'm constrained for lending very long term. If I look at capital market participation, the bond markets in India have famously been shallow. The reasons are myriad, and a lot of conversation has happened around it. So the way that the tenor elongation for RE is something that cannot be done away with. There is no way. Another thing that banks do, and not very successfully, is that what they will do is they will underwrite the loan for 20 years, knowing fully well that they're not going to keep the loan on their books for 20 years. There is something called the loan syndication market. So they will take that loan and sell it off into the secondary market to another set of lenders who will then keep it for 3 years. Then they will sell it to another set of lenders who will keep it for another 4 years. So they are trying to kind of circumvent this particular problem of ALM constraint and risk participation. But that is not very successful because each bank will have its own borrower limits as to each group can be only given so much money, each borrower can be only given so much money, etc. So there are constraints to that, even to that. So from that perspective, bank finance is constrained, capital market participation because of the shallowness and lack of liquidity of a lot of loans, a lot of debt instruments, a lot of debenture instruments, them being rated also not very, very highly always, especially in the case of credit deterioration that happens because of lack of generation or because of delayed payments and no lack of support or lack of support from the sponsor, etc. So they are constrained, and they are finding it difficult to then crack that. How do they crack it? So then there is this thought that, okay, if the rating universe for RE is moving towards A, and fine, you bring the prudential limits down to A, but you add a bolster of EL1, which says that, okay, you are patient capital. You, unlike a bank, you don't have an ALM mismatch. You don't have a deposit taking logic. You don't have an interest payment or something on that deposit. Thereby, you don't have those pressures. So it's patient capital marrying short-term mismatch wala deployment. Long-term is a possibility because even the annuities insurance can go on forever. So it works. And it is coming from that perspective to unshackle the constraints today on capital market participants, patient capital market participants.
Thank you. Throughout the session, we have more than 100 participants. I'm glad to see the interest of participants and they find this topic useful and to engage with. One more question is, given the risk parameters in RE and power sector is unique and counterparty risk is a serious risk consideration, what is the risk weightage assigned to counterparty risk across CRAs in the overall rating scale? And the first thing is there any standardized methodology to assign different sort of risk weightage to different counterparty? And is that information available in the public domain? I think that's also a very interesting question.
Yeah, very, very, really, really timely. So the answer would be that no. There is no publicly available document which details as to what is the risk weightage that each CRA applies when they are, calculating the credit risk measurement of a particular, RE project, especially what is the weightage that they give to the counterparty quality versus, the project quality or the performance quality. There is no, so the fun is, SEBI regulates CRAs and regulates, let's say, the probability of default benchmarks. It will regulate the methodology of calculating the cumulative default rates. However, how do you calculate the probability of default and how do you calculate, what is the weightage for what is left to the intelligence and to the sort of assessment of the credit rating agencies, because they were mandated to be independent credit voices. That is how credit rating agencies came to be. So that independence still now has been definitely given in the hands of the CRAs, where there is a trend that one can come up with that, if it is a central government counterparty like a SECI or an NTPC, obviously there is a lot of comfort drawn from it, which seems to be the case in the newer lot of SECI PPAs that were signed. And if it's a DISCOM which has got obviously checkered history, even if the current performance is all right, it will weigh on the rating. But exactly how much, and then which CRA does how much, and is it standardized? The answer to all those questions is no. And in fact, that is also forming, I don't want to beat this dead horse, but it's forming part of our recommendations that all of this, these assumptions, the reality, what has changed, estimate versus actual, all of this, if it starts becoming part of the credit rating agency output, the rating rationale output, that will bring a sea change in the transparency and accountability of then that particular risk measurement technology or methodology.
There is one very related question, and you mentioned that in your presentation as well as it is covered in the report, that there are instances of inconsistent treatment of ratings by different rating agencies. So can you elaborate a bit more on what you mean by this? And could it be linked to the kind of freedom given to CRAs that you mentioned just now?
Sure. So when I said that point on inconsistent ratings, and this is covered in the report of expected loss rating scale, it basically, there are two case studies. So one of the case studies that we have covered in great detail with, year by year, month by month changes in the rating is for the same rating, the same loan that was taken for the same project being rated by two separate rating agencies, totally different from each other, responding very differently to the same set of circumstances. So for example, both of the rating agencies started at the same starting point, that they gave a particular strong rating to that particular loan asset. And then when the risk started playing out and the credit profile started deteriorating, there was a marked lag in the response time of one CRA versus another. So, whether it is about changing the outlook from positive to stable or stable to positive to negative, between the two CRAs, there was nearly an 11-month difference. So CRA1 would have responded month 1, CRA2 did the same action 11 months down the line. Similarly, when the unsupported rating rule was brought out by Securities and Exchange Board of India as part of the many good rules that they've been bringing out to bring around transparency, the unsupported rating was given in different bands by each rating agency. One rating agency assigned it in the A band, one rating agency assigned it at the lower end of the same band, and then slipped into the lower band at the next review. So it just goes to show that, and for somebody who's not worked in the sector, this might sound a bit innocent, but for somebody who's making up an investment decision on this credit signaling, an 11-month delay in a negative outlook assignment can mean that your entire call has gone wrong, especially if you've taken a secondary market loan participation call. It means that you will have to provide for this loan now more on your books. It dents your profitability. So there are many more ramifications to it. And what is also interesting is then that not only is it that it is the same rating and it's the same loan facility, the same project, etc. What is interesting is that the justifications in the rating rationales are also similar. So it's not that there is new information in one or different information in the other. The same set of facts, you can have totally two diverging views. And it's very interesting. In fact, when I did it, it was quite eye-opening. And to answer the second part of the same question, that yes, this is unfortunately part of that conflict of interest and all those other issues that we talk about because of the issuer pay model for CRAs is concerned. In fact, there is a paper that the Reserve Bank of India brought out in 2019, where it had done a 7-year analysis of the 7 credit rating agencies of India and actually come out with many much more detailed anecdotes of the rating shopping that they called it. That rating agency A gave this rating that was not acceptable, so then the company went to a different rating agency, it got a better rating, and then what happened to the ratings after that. So the Reserve Bank of India themselves in their own publication have discovered this element of reality. Great depth.
One more question that comes up is, essentially we are asking financiers to publish a lot more data in terms of performance of different entities and different generating projects. So what would be legal and confidentiality issues involved in such disclosure? Are there ways in which this data can be made available for sort of policymakers, for general public, for researchers, without compromising those confidentiality and privacy related issues? So any thoughts on that would be useful. Thank you.
Sure. I think that's a very important and relevant point when we're talking about legality, when you're talking about this, there is a certain veil of secrecy under which financiers like to operate. They are finally operating in a competitive sort of environment. So it's a valid worry, or it's a valid ask that, how do we navigate this? I think the whole point is that any which way, because let's say bankers and financial institutions which are under the supervisory review or oversight of the Reserve Bank of India have to disclose their entire loan book in great detail anyway, as of today. There is no two ways about it. What we are suggesting is that we are saying that since refinance is going to be such a large piece going forward, and it's got very specific nuances of credit risk like we just discussed, just carve out that piece separately as far as your reporting is concerned to your own regulator. So from the banking side to their own regulator, where it is concerned about making the particular, that data public, barring very competition sensitive points like the pricing of that particular loan or the fee structure of that particular loan. What is happening in the project, the underlying project ka performance kya hai, uske delays kya hai, finally computing down to what is the debt coverage metric, etc. I don't think there should be any problem. I think the most important point, which very hard fought battles, let's say in banking space, are finally about pricing and what is going to be the fee structure and what's the P&L aspect of things. That can be left out probably when the public data is being disseminated, which, by the way, that data also goes to Reserve Bank of India even today. But for the public, let's say you don't want to give it, that's all right. But at least as far as how much money you have given, what is the tenor, what is the repayment schedule, and what is your experience of lending for that particular project, and what is the servicing history, etc. That I think will have no such flavor of getting into hot water as far as legality or competition unfriendliness is concerned.
I think that clarification is very useful, because the moment we start talking about disclosures in terms of data and actual performance, some of these issues need to be addressed. I think we are close to 4 o'clock, but I will just take this last question. While or at the time of assigning credit ratings, do these credit rating agencies consider any climate risk in terms of actual performance? Because especially for RE projects which are significantly dependent on weather patterns, do they sort of internalize or assess some of these risks? Yeah.
Okay, so let me answer it in two ways. So one is that this ideology that now climate risks have to start translating into actions or policy actions or sort of strategy response by financing entities in a particular country and their central regulator is a fairly new understanding, that the climate risk has to be translated into a number and you have to run some simulations around it. So that particular thing hasn't started off in a very, I would say, large way, mainly because the taxonomy and the methodology of stress testing for climate, etc., all of these ideologies, these strategies, these, this whole framework is at a very nascent discussion and, working paper stage at the Reserve Bank of India itself. So Securities and Exchange Board of India and other regulators as well are definitely not at that place where they have come out with any guidelines or anything of that nature. However, any which way, because it's a estimate based sort of setup of the debt facility, there is anyway a scenario analysis that was being run or a stress testing that was being done in case of generation shortfall. Now, climate risk or climate change, for example, could be one of the sources for that generation to vary. But in effect, in reality, the fact that agar maine 10 bola hai and if the generation becomes 8 is something that is being stress tested. Whether it is being responded to appropriately by each CRA, that is a separate issue. But yeah, in essence, it is being stress tested, not under the, let's say, the box of climate change response or measurement, but generally stress testing. Climate change could be a source of that particular deterioration.
There's one more question, rather I would say good comment, and it is about essentially asking agencies such as CEA, which already have a mandate of compiling data from many RE projects to start compiling the data about actual performance, about the ratings provided to different projects, and start publishing that data. I think that's essentially is the point, that different sectoral regulators, sectoral agencies need to start looking at it from this comprehensive perspective and start collecting that data, putting it in the public domain, because this again goes back to the issue of which agency has the legal mandate. And here is a good example that CA being sort of the empowered entity to collect generation data and actual performance data from different generating companies would be more logical entity to compile that data and make it available for public. Similarly, maybe RBI and SEBI and other finance sector regulatory agencies have the mandate to compile data related to financing and debt to this RE sector. So they can take lead in making that data available to general public and making it accessible. So I think with that note, we can close this session. We are at 4 o'clock. And thank you again, Sonali, for nice presentation, and to all participants for being with us throughout this session and asking very pertinent questions. As we said, both these reports are available in the public domain. They are available on our website. And if you have any further questions, comments, critique, or suggestions, please do write to us. We'll be happy to engage further on these topics. So thank you once again. Bye-bye.
Thank you. Thank you, everybody.